Today on the Joseph Carlson Show, we have an interview with possibly the biggest bear on Wall Street today, David Rosenberg. He gave this interview and he was incredibly bearish. He thinks that investors are in over their skis, that they can't see the doom and gloom that's coming. In fact, he says at one point that they're going to be in tears.
It's going to be coming in the next 12 months, or else we'll just take the history books, throw them out. We'll tell everybody that Mother Nature and the business cycle has been repealed and that recessions don't exist.
This interview is a spicy one. We're going to be looking at it. I'll be going over his claims of why he's so convinced that within the next 12 months, we're going to have a terrible recession and a bear market. Now, to balance things out, we also have Tom Lee, who is a bull on the market. In fact, he thinks the rest of this year, the market will head higher. So we'll be looking at the arguments that Tom has to make as well. Now, it's the weekend. We know what that means here, that we look to TikTok to get our investing advice. This one, we have advice of someone that is going to become a trillionaire.
Want to become a billionaire?
No, I want to become a trillionaire.
That's right. He's going to become a trillionaire, and he was kind enough to explain how he's going to accomplish that in this TikTok. So we have all of that to get to, plus much more. Now let's go ahead and jump right in. The first thing that I'll mention is when we look at these type of interviews of people that are incredibly bearish, some of them you can instantly write off because they have really poor arguments. They don't have anything that interesting to say. A lot of them are just salty that they missed out on the recent rally in the markets. But in other cases, there's some bear arguments that are a lot more convincing. They have a lot more merit to them. And those ones are a bit spooky. They're a bit unsettling for investors like you and me that have a lot of money in the market, that we have our savings, we have stuff we've worked for to try to contribute to our portfolios, build up investments and assets that we think are good assets, and then we're hearing about how everything is going to crash. Everything is going to go to doom and gloom. I'm in that situation right now. With the passive income portfolio, I've worked very hard to get this portfolio where it is today. I've made major sacrifices in my life. I haven't bought new Teslas and new vehicles every year. I haven't done anything super flashy so that I could put every penny I have into this portfolio. Now, so far, it's gone really well. The portfolio has been beating the market for the past couple of years. It's done really well. It's at a gain of $88,000, $65,000 of market gains, $22,500 of dividends. So we have money coming through both capital appreciation and dividend income. And the companies that I've selected have done fantastic. They are killing it right now. Apple has been an enormous winner, Microsoft as well. The newer positions that I just recently bought into are off to a great start as well, S&P Global, MasterCard, and even Intuit. Some of the ones that I've held for a little bit longer have done particularly well. Texas Roadhouse is in the green, nearly $12,000 at this point. Costco and other consumer companies have been big winners as well. It's currently up around $9,000. So I'm feeling good about the portfolio. I'm feeling good about the progress I've made, about the dividends I'm being paid, about the intrinsic value with revenue, earnings per share, free cash flow per share growth. I bought a lot of companies that I think are really wonderful assets that continue to compound their intrinsic value. And then here we are about to listen to one man that's gonna spoil it all, that's gonna tell us how none of that really matters and all of it's gonna go away. So let's go ahead and jump into this, and I'll go with you of how I handle these type of interviews and these type of perspectives. The first thing that he talks about is the situation the stock market is in right now.
Well, I mean, the stock market hasn't really been rallying since the Fed started raising rates. That was back in March of last year, and last year the S&P 500 was down almost 20%. For the year as a whole. The stock market at any given moment of time is going to be influenced by a whole range of factors. You really have to take an eclectic approach. And, there's fundamentals, there's valuation, there's market positioning, there's fund flows, and there's momentum. And there are times where you can get a serious momentum-driven market. And so I don't think we can argue a 19 multiple. That's pretty rich. Benchmarked against risk-free rates over 5%, bit of a no-brainer. Of course, we've had the generative AI boom going on, so on and so forth. It sort of looks a little bit like the internet mania we had back in the late 1990s. Again, it was partly fundamental, but that was a massively momentum-driven market.
So his first argument is that, first of all, the S&P 500 is a little expensive right now. It's at a 19 forward PE ratio. And that is accurate. If we look at the actual numbers here, the S&P 500 index, the estimates of next year's earnings put the S&P 500 at above a 19 forward PE, which is a little bit higher than its historical average. Now, he goes on to argue that this is a momentum and sentiment-driven market. It has nothing to do with the fundamentals. And he goes on to highlight his big concern of how the market doesn't seem to care about history or what it's learned from prior rate hiking cycles.
The reality is this: unless you're willing to say that hope is going to triumph over experience, how many aggressive, pernicious Fed tightening cycles of the likes we're seeing right now, the most acute tightening cycle since 1981, and people are saying that this is somehow going to end well, that somehow the U.S. economy, a credit-driven economy, is immune to such higher interest rates, is totally ridiculous. It just tells me that people can't see past the tip of their nose. The next 12 months is going to be really rough. That's when all the lags from the Fed are really going to be kicking in hard.
It all seems like it makes sense. One of the things he says there is that something had to break. Something has to break, and that really hasn't happened yet. And he doesn't believe that the regional banks was enough. Now, I would argue that what seems similar to the year 2000 was more what happened in 2021 with companies like the ones found in ARK Innovations ETF, companies that were going up hundreds and hundreds of percentages for no other reason than investors being excited about their future potential. And we can clearly see what broke. A lot of investors got crushed in these companies. They're still down 70% from their high, and many of these companies are never coming back. So we have had some things break, but obviously he doesn't feel that that's enough. He thinks that there needs to be more happening, specifically with the economy. The next big argument he gives is on the Fed and their focus. He believes the Fed is too focused on lagging data.
There's a risk that they will go 2 or 2+. And it's not a forecast, just an observation as to what the Fed is looking at. This is not our father's or grandfather's Fed. I don't get a sense this Fed has confidence in its forecasts or confidence in its models. It is basically telling us that it is data dependent. And everybody comes on CNBC and they talk about, well, yeah, of course, they're data dependent. But I've never seen a central bank so focused on the data that are inherently contemporaneous and lagging. They're focused on inflation. Even though inflation expectations are so well anchored, they're so nervous that at some point the dam is going to break. But they're focused on inflation, service sector inflation. Service sector CPI is in the Conference Board's index of lagging economic indicators. They are anally retentive on the unemployment rate, which is in the index of lagging indicators. You know, and of course, we're talking about non-farm payrolls tomorrow. Nobody talks about the work week. So we're adding more bodies and we're furloughing them simultaneously. It's a very interesting dichotomy. It's like cognitive dissonance. Hire more people, cut their hours. The work week is back to where it was in April 2020 when the economy was locked down. And nobody talks about that. So the Fed's focused on lagging indicators. They inherently take time to turn.
So he's arguing that all of this is going to have a lagging effect. Now, the Fed is aware of that. They know that inflation numbers and those type of things have a lagging effect, but he is correct in saying that they are intensely focused on the inflation number, that is their main thing they're concerned about. They consider that the biggest risk above all other risks. So as they try to bring down inflation, they are okay causing some trouble in the economy. And he believes that that's going to happen as well. It's just going to happen on a lag schedule. He also goes on to bring up the inverted yield curve.
Tightening into such a deeply inverted yield curve, which of course everybody says is a relic of the past, ignore the yield curve. They say that every cycle. I think the Fed has already gone overboard. Then again, maybe a recession was always in their plan to destroy the inflation they created through the overly accommodative policies they pursued in 2020 and 2021. So we'll correct one mistake with another mistake.
The yield curve is a comparison of the yield on two different treasuries. We have the 2-year treasury here, yielding 4.98%. So 4.98% 2-year. And then we have the 10-year, a longer term treasury. You're taking out a longer term schedule and it has a lower yield. That is typically abnormal. Longer terms usually mean higher yields. So the yield curve is when the shorter duration treasury has a higher yield than the longer duration treasury. That is the inverted yield curve. And when we plot this out over time, we can see all the times that the curve became inverted. That's represented by this chart going negative. And then we can see all the times that we had a recession. That's represented by the gray columns. Every time that the yield curve became inverted, it preceded a recession, without fail. And what we see right now is that the yield curve is deeply inverted. This is one of the worst inverted yield curves that we've ever had. Now, the yield curve is inverted right now, but what we haven't seen is a deep recession. We continue to see decent jobs reports, full employment, lots of people traveling and spending money. And he addresses that here.
It's like they were saying the same thing in 2000. Oh, it was in 2001. Where's the recession? I got that in Merrill every day in 2007. Where's the recession? Where's the recession? Okay, yeah. Well, it came in big time in 2008. So, yeah, the lags this time are longer because the Energizer Bunny called the Biden budget buster that was actually gave the fiscal stimulus was a gift that kept on giving. But you see, that's coming to an end. And now we're going to see the full throttle of these lags that everybody's talking about. Well, where are the lags? They're staring us in the face. And I think, right, it might not be this or next quarter story, but it's going to be coming in the next 12 months, or else we'll just take the history books, throw them out. We'll tell everybody that Mother Nature and the business cycle has been repealed and that recessions don't exist. But they always follow the pattern of what the Fed's already been doing.
He is convinced that a recession is coming. It is inevitable. People wonder where the recession is until it finally hits. Now, I'll admit that this interview is a little bit more spooky than most because he's very bearish and he has a lot of convincing arguments. There seems to be more merit to what he's saying. And we know that part of what he's saying is true. There is a probability, in fact, it may be a high probability, that we enter into a recession over the next 12 months. So what does that mean for us investors? The way that I think about this is pretty simple. I always assume that there's a decent probability that we could go into recession. It's a normal course of the economic system. It's happened over and over again all throughout our country's history, all throughout the market. Recessions are normal. They do happen from time to time. Trying to avoid them continually for decade after decade seems like it's nearly impossible. So I can make the basic assumption that David Rosenberg may be correct. Maybe we will go into recession. That could be a wake-up call for a lot of investors, but it should not be. The way that I look at it is with every company, when I'm doing analysis, I'm looking at whether or not they can make it through a recession, or whether or not that really destroys their capital position. For example, with companies like MasterCard, Intuit, and S&P Global, these are companies that have very resilient revenue streams, incredibly efficient businesses, they don't have a lot of fixed expenses, and they have incredibly good balance sheets. These companies will not only make it through a recession, they'll sail through it. Of course, their earnings will be impacted negatively for the year or two in the recession, but that eventually recovers. Life moves on. Recessions turn back into bull markets, into economic growth. So they just have to make it through. That is the most important part. The companies that don't make it through recessions are typically heavily levered companies, companies with massive debt on their balance sheets. The more indebted the company, the riskier it is during a recession. Out of my portfolio right now, Vici is by far the most indebted company because it's a real estate play. This one is the most at risk of going bankrupt during a recession. Now, I don't believe that will happen. I think that the industry they're in is pretty resilient. I think the probability of that is incredibly low, but by virtue of the amount of debt they have, this one has the biggest risk profile. The other companies in my portfolio, whether you're talking about Costco, which carries no debt, this company has essentially zero risk of going bankrupt. There's almost no chance of them not making it through a recession. We even have companies that are restaurants. The earnings will be impacted during a recession, but this company carries no debt. They have no long-term debt, so they will be able to make it through a recession. And another thing that I'd keep in mind, when the environment gets more difficult, when things get more difficult for every company, and companies are struggling to grow earnings, the ones that are able to grow earnings through any environment, for example, the higher quality companies that have immense pricing power, they will become prized assets. The companies that have the organic growth, the pricing power, and the incredible balance sheet become worth more in the eyes of investors during troubling times than during good times. So if we enter into a recession, that will be a bummer. Likely stocks will trade down. But as far as I'm concerned, I feel fine even with that eventuality. Even if that does happen, I know my companies are going to make it. Now, of course, we have another view on this. Tom Lee, for example, does not believe we're going into recession. In fact, he believes the opposite. He believes a recession has already been priced in. That's the reason that stocks are doing so well right now.
Last year, the 27% decline in stocks, which took 195 trading days, is the type of decline you expect to see in a recession. So I think a recession type event was priced last year. There was a panic bottom in October, and now we've been rallying for 176 days. By July 26th, we'll have rallied 195 days. There's never been a bear market rally that's lasted longer than the decline. So by July 26th, it's proof that we're in a bull market.
Yeah. Now, whether or not it's Tom or David that ends up being right, either way, your portfolio should be positioned for either outcome. Now, moving on, it's Friday. We have the weekend here where we go to TikTok to get the best advice on investing and finance and basically life in general. And in this one, we have something special. We have an individual here that's going to tell us how he plans on becoming not a billionaire, but a trillionaire, the first trillionaire. Let's go ahead and take a look.
Want to become a billionaire?
No, I want to become a trillionaire. The richest person on the planet right now is around $200 billion, and 5 people competing in that space. They're the top 100 billionaires currently in the world range from 9 billion up to 200-ish. I am 43 years old, and I have this crazy health routine, anti-aging, everything with modern medicine. If you study the futurists, I'm going to be 140 years old. So I'm planning on 100 years.
Okay. Let's pause there. Did I just hear that right? Did he say he's going to be 140 years old? Let me rewind that a little bit here. I'm going to be 140 years old. That caught me a little bit off guard. That was out of left field. Here I am, impressed with his ambitious goal to be the world's first trillionaire, passing up Jeff Bezos and Elon Musk, who started Tesla and Amazon. He's going to surpass their levels of wealth. And that's not even the most impressive part of this little TikTok here. He's also going to live to 140. Now, I'm not sure what the oldest person on the planet is, but 140 has to be up there. That could be the oldest person ever alive. But because of apparently his diet and exercise routine, he's going to make it to that level, his anti-aging routine. Now, I'm no doctor, so I can't say for sure, but I would say that he has around the same likelihood of living to 140 years old as he does of becoming the first trillionaire. Well, let's go ahead and listen to the rest of his plan here.
So I'm planning on 100 years. I have time to become a trillionaire. I know how many months I believe I'm away from being a billionaire because that's been a 13-year goal. I'm deep into private equity and growing companies, and just my social media company alone last year popped a 9-figure valuation. The goal of billionaire, that I set that one up in 2009 and I'm close, but no, I want to be a trillionaire.
So there you have it, everyone. You can become a trillionaire too. All you have to do is a lot of private equity deals and live to 140 years old. That's all for this episode. I hope you enjoyed, and I'll see you in the next one.